Hello and a warm welcome to Talking Stocks. I am Gugulethu Cele. In studio with me, Sean Ashton and David Gibb, both from Anchor Capital. Now today we're talking Beacon Roofing Supply, an American publicly traded company which sells residential and non-residential roofing products as well as related building products in North America. The company currently consists of 13 regional companies in 42 US states and 6 Canadian provinces. Clearly not a company that I've been familiar with. I saw Beacon and I thought of the other namesake, which
business.
Exactly deals with chocolates and sweets, which clearly shows what my preferences are in life. But if we do look at Beacon, a quick overview, is this something like a cash build that we're talking about?
So it's quite off the radar, I concede that, but it's a business that's come up on our screens and looks pretty interesting. So, and really the story relating to this company is they're the second largest distributor, so it's a Bidvest type business, a wholesale distributor of roofing products in America. And the whole story around them is that because they're so large, they're acting as a consolidator of what is essentially quite a fragmented market. If you look at the roofing supply market in America, they're number 2 and they've got about 16% market share. But there's about 48% of the US roofing supply market that's made up of 1,500 independent distributors. Mm-hmm. And these guys have been continually consolidating that market over a number of years, and they continue to do acquisitions to mop up that demand.
I understand that they have an interesting view because not only do they supply these goods but also deal with repairs. How does that come about when it comes to their business mix?
So that relates specifically to where they get their final demand from. And I think it's an important point to make, in that a lot of people think American housing market, not a good news story. It's it's come off multi-year highs leading up to the 2008 financial crisis. Residential building plans have never really recovered to their pre-crisis levels, but it looks like there might be a bit of a recovery in place now. So you're coming off a low base, but importantly, in terms of the risk of this business, it's very much a repair-driven business. They don't generate the majority of their sales from new builds. It's very much a repair and an aftermarket type of business. So about 80% of their demand by sales is as a result of leaking roofs, damage from storms that have to be repaired. So it's quite a nice annuity nature business. And if you look back to the 2008 financial crisis, when new plans for residential buildings fell off a cliff, their sales only dropped from something like $1.8 billion to 1.6. So they weren't that heavily impacted by that time period.
So true. That's not a big knock at all if
Sure.
you look at the building environment that they're situated in. If we do take a look again at one of the first graphs we had up, the estimated roofing industry market share, does this perhaps give us more details as to where the growth and where the income for this particular institution is coming from, David?
Yes, I mean, it's about a $20 billion market. And it's, for them, they roughly half of their business is residential market related. About 35% is non-residential, and then there's a 15% slug which caters for other sectors. Not specifically either of those two. So the residential market is forecast to grow by just over 6 to 7% for the next several years, and that's slightly higher than the non-residential market. So the good thing about the roofing market, I guess, in the US is that there's no bubble in that market. I mean, you would argue that the roofs at the moment, the average age of the homes in the US now is about 38 years, whereas if you go back to about 1985, it was 23 years. Mm-hmm. And you'd think that a lot of people have delayed fixing their roofs. I think when times are tough, and generally the Americans have been quite conservative in their spend. So probably people have probably delayed fixing up a lot of existing roofs at the moment. So you'd argue there's probably pent up demand for people to get out there and fix leaky roofs, or just to actually loosen up the purse strings a bit and spend on their homes.
Nothing worse than that drip that comes through the roof when there's rainy weather. But you did mention acquisitions of late,
yes.
Sean, and I understand RSG is one of those.
So there's been a big acquisition that they did last year, and I think this is key to the whole thesis. So they've acquired a business called RSG, which is a big acquisition by their standards. It was about $1.1 billion of enterprise value, a similar number in terms of sales. So it's boosted their sales pro forma from about $2.25 billion to north of $3 billion. But really the story here is that they acquired a business that was underperforming, so its margins are significantly lower at the operating level compared to that of Beacon Roofing. but there's substantial synergies. They believe that they can extract about $50 million worth of synergies from this business. And once you combine that with the existing Beacon business, their margins should go from 5% last year to about just north of 6% for FY16. It's a December year end. Management's public guidance is that they should get to between a 6 and 8% margin over the next 3 years or so. So there's still margin upside as the group continues to build scale, and hopefully the housing market in the States picks up and provides a bit of cream. But I think the important aspect of the investment thesis is that they've taken substantial debt on in this acquisition, and organically they've also been investing quite heavily in new branches in the last couple of years, which means a lot of capex relating to trucks, a lot of additional expenditure, and we're now going into a period where the capital expenditure is likely to be lower than average for the next couple of years, and
Sure.
materially below depreciation charges. So that means that your free cash flows are going to be much stronger than earnings for the next few years, and they're going to deleverage the balance sheet from probably 4 times debt to EBITDA following the acquisition of this RSG business to less than 2 times over the next 3 years. Now, why is that important? It's important because at the same time that margins are going to rise and drive substantial growth we expect in operating profits, you're also going to see a substantial reduction in the interest charge of the business. So we're expecting that they can probably, by the time you put those two equations together, we forecast that this business should be able to grow its earnings by 25% a year for the next 3 years.
Sure.
Annually.
That's impressive, double digit and in the 20s as well.
Yeah.
And this obviously ties into the timing with regard to the roofing market in the US. I understand are below long-term levels.
Yes.
Perhaps if you can explain this for us.
Yeah,
further.
so I mean, essentially what we're saying here is, as Dave alluded to earlier, replacement and repair and new build decisions have been delayed for a long time. Houses are getting older in America, and certainly the aggregate level of demand as defined by roofing demand essentially is below where it's been at its previous peaks. Which means that there is room for improvement, and certainly our discussions with management indicate that they are seeing some signs of life in terms of a cyclical recovery in the housing market in America and the roofing market accordingly. So we're not banking on that necessarily. We still think that they have the ability to grow top line organically at least 5%, up to possibly 10%, but if the housing market really picks up, it might add cream to those numbers.
What about strong cash flows for the long term as well as leveraging? Does that play any element of dynamics here?
So the way we've thought about this is to say, in terms of the valuation, there's a lot of debt in the balance sheet right now. We've mentioned that cash flows are going to be stronger than usual relative to earnings in the next couple of years. And you're paying about a forward 19 or 20 PE for the share now, which sounds reasonably high for an industrial distribution business, but it's obviously affected by the capital structure of the group in the sense that there's a lot of debt, and debt doesn't cost you much money. So when you look at it on an EV/EBITDA basis, you're paying about 10 or 11 times for the company, which is fair, we think. And taking into account the fact that we expect that their debt will reduce from circa $1.1 billion today to probably $700 million by FY19. If you apply a similar EBITDA multiple in FY19 to the kind of earnings numbers we're looking for, that would result in roughly an 18% annualized return from the share price.
And that's
that would get you to about $64 a share in 2019. We're sitting at about $40 a share today.
True. I see that's not too far off from the consensus, as you mentioned, with regard to earnings per share.
Yeah.
There.
So consensus, Bloomberg consensus is looking for about just north of 20% per annum earnings growth. We're looking for about 25. We're a bit below on our year one numbers, that's FY16, but in the outer years our forecasts are a little bit stronger.
If we do look at the value as well as what this means for returns, ultimately if we're in comparison to some of its peers in the industry, how are we faring here?
So we think this is quite a specific opportunity, and we're not too worried about the much smaller peers in the industry.
Would Home Depot be one of them?
Not so much. They're more a retailer. So this is a distributor of products. You could almost think of the Bidvest Food Services business, except as it applies to roofing.
Okay.
So they're a distributor. They're neither a manufacturer nor a retailer. They're the wholesaler in between.
Perfect.
But because they're very large, they are consolidating a fragmented market, both organically and via acquisitions of smaller competitors. But the attraction for us is because they've done this transaction now, they've got a lot of debt in their balance sheet, their cash flows are going to be strong, and they're likely to deleverage their balance sheet significantly in the next few years. So it's quite a specific story, this, relative to their peers.
Well, it's time now to find out from our experts whether to buy, hold or sell Beacon Roofing. David, let's start off with you by getting your view. Buy, hold or sell Beacon Roofing?
I think for me it's a hold. I'd take a slightly more conservative view on the share than Sean would. Obviously they've got to manage through a period of taking on some gearing, and they've just got to ensure that the market doesn't soften. It has been a fairly tepid recovery in the US, and obviously we expect the recovery to carry on, but there is a chance that things could slow still, and there might be a lot of stock in the system out there. So they've got to manage through a period of bringing down their gearing. So for me, I would sit, and I would be a hold for now on this share.
Sean?
I'm leaning more towards a buy. And really the thesis is around the fact that I don't think we're having to bet on too much of a housing market recovery to support their growth. We really know that a lot of it is base load demand from repairs. So I think there's a nice annuity nature to their business. And forecasting the level of cash flows is likely to be lower than average risk, I believe, given that they've given quite specific guidance around capex. In terms of the way we think about value, I'm exiting it at the same kind of multiple that it's trading at now, 3 years out. That leads me to a value of $64 a share. If they achieve anything, or if the market applies anything close to that type of metric, and they achieve close to their targets, mid to high teen returns in US dollars is definitely going to end up being a buy in my book.
Well, we'll leave it there for today. Mixed views, hold as well as a buy coming through for Beacon Roofing. But a big thank you to both my guests for joining us this evening, Sean Ashton and David Gibb, both from Anchor Capital. I'm afraid that's where we have to leave it for this week, but join us again next time where we talk more stocks.